What if I told you that the biggest players in crypto, the hedge funds, the family offices, the institutions managing billions, are not doing what you think they're doing? They're not just buying Bitcoin and hoping for the moon. They're not gambling on meme coins at 3 a.m. They're running a strategy so precise, so calculated, and so deliberately hidden from retail investors like you and me that if you ever discovered it, it would completely change how you look at this market forever. And here's the thing, they hope you never do. Because the moment you understand how they actually operate, you stop being the exit liquidity. You stop being the one who panic sells at the bottom. You stop handing your gains over to people who already knew what was coming. Today, that changes. I'm going to walk you through the exact framework hedge funds use to dominate crypto markets. Not the watered-down version you'll find in a YouTube thumbnail, but the real mechanics behind the strategy. The one that lets them profit when Bitcoin crashes. The one that lets them profit when altcoins bleed. The one that lets them profit in sideways markets that bore retail investors into making stupid decisions. Stay with me, because by the end of this video, you'll never look at a crypto chart the same way again. Let's get into it. Point 1. They trade asymmetry, not prediction. Here's the first thing you need to understand about institutional crypto strategy. Hedge funds are not trying to predict the market. Let that sink in for a second. They are not sitting in a boardroom somewhere, staring at candlestick charts and debating whether Bitcoin is going to 60,000 or 30,000 next. That's what retail traders do, and retail traders lose. What hedge funds are doing is something far more powerful. They are trading asymmetry. What does that mean? It means they structure every single position so that the downside is capped and the upside is open-ended. Every trade they enter has a defined risk profile before they ever put capital on the line. Think about it like this. If you buy one Bitcoin at $40,000 with no plan, no hedge, and no exit strategy, your downside is theoretically 100%. You could lose everything. Your upside is unlimited, sure, but so is your pain. Now imagine instead you allocate 70% of your capital to Bitcoin as a core holding. Then you use the remaining 30% to buy put options, essentially insurance policies, that pay out massively if Bitcoin drops below a certain price. Suddenly, your downside is controlled. You've capped your maximum loss, but your upside, still wide open. That's asymmetric positioning. That's what the professionals do. They don't need to be right about direction every time. They just need to make sure that when they're wrong, they don't blow up. And when they're right, they capture outsized gains. This is why hedge funds survive crypto winters. While retail investors were losing 70, 80, 90% of their portfolio value in the 2022 bear market, certain funds were up. Not just surviving, actually up. Because they had structured their exposure to profit from volatility itself, not just from price going up. The lesson here? Stop trying to predict. Start structuring.
Point 2. Delta neutral strategies. Making money in any market. All right, let's go deeper, because once you understand asymmetry, the next thing institutional players use is something called a delta neutral strategy. And this one is genuinely mind-bending when you first encounter it. Delta neutral means your portfolio is structured so that it doesn't matter whether the market goes up or down. You profit either way. How is that possible? Let me break it down. In crypto derivatives markets, on platforms like Binance, Deribit, or CME's Crypto Futures Exchange, you can simultaneously hold a long position and a short position on the same asset, structured in a way where the gains from one side offset and then exceed the losses from the other. Here's a real-world example. Say Ethereum is trading at $2,000. A hedge fund goes long on spot Ethereum, meaning they actually own it. At the same time, they short Ethereum futures contracts at a premium. Why? Because futures often trade at a higher price than the actual spot asset, especially during bull markets. That gap, called the basis, is pure, almost risk-free profit that gets captured when the futures contract expires and converges with the spot price. This is called a cash and carry trade, and institutional desks run this strategy at scale, pulling consistent percentage returns every month, regardless of whether crypto is pumping or dumping. But it goes even further.
Some funds run volatility harvesting strategies, essentially selling options premiums to retail traders who are emotionally buying calls during euphoria and panic buying puts during fear. The fund collects that premium income consistently, like a casino collecting the house edge. You know what's fascinating about this? Retail investors are literally funding these strategies every time they FOMO buy a call option on Ethereum because they saw a price prediction tweet. The hedge fund is on the other side of that trade, smiling. The takeaway from point 2 is this. In crypto, you can engineer profitability. The market going sideways doesn't have to mean you make nothing. Delta neutral thinking is how you turn market indifference into income.
Point 3. The information edge they've built that you can't see. Now, here's where it gets uncomfortable, because points 1 and 2 were about mechanics, strategy structures you can actually learn and replicate. But point 3 is about something harder to copy, and it's a big reason why hedge funds consistently outperform. It's information asymmetry. Hedge funds do not operate with the same information you and I have access to. And I'm not talking about anything illegal here. I'm talking about the legal, structural advantage that comes from having resources, relationships, and technology that retail investors simply don't have. Let me give you some specific examples. First, on-chain analytics. While most retail investors are reading Twitter threads and watching YouTube videos, no offense, hedge funds have entire analytics teams pulling real-time data from the blockchain itself. They're watching wallet movements. They're tracking when large addresses that are known to be associated with exchanges or major funds start accumulating or distributing. They're monitoring miner behavior on the Bitcoin network to understand when selling pressure is about to hit. They're watching smart contract interactions on Ethereum to see which DeFi protocols are seeing unusual inflows before any public announcement. Firms like Chainalysis, Nansen, and Glassnode sell this data, but institutional clients get the premium tier, the API access, the proprietary dashboards that retail traders never even see. By the time a signal shows up in a public crypto news article, the institutions have already positioned themselves 3 moves ahead. Second, order flow analysis. Hedge funds that have market-making relationships with major exchanges can see aggregated order book data that reveals where large buy walls and sell walls are positioned. They understand the liquidity landscape before placing a trade. They know where the stop losses are clustered. They know where retail traders are likely to get liquidated, and they position accordingly. This isn't conspiracy. This is just structural advantage. The same thing exists in traditional finance. It's just more visible in crypto because the market is younger and less regulated. Third, early access to projects. When a promising Layer 2 protocol or a new decentralized exchange does a seed funding round, who do you think gets allocation? Retail investors don't even know it exists yet. By the time it hits a major exchange listing and you see the news, the institutional investors who got in at seed prices are already up 500% and deciding whether to hold or distribute. Understanding this is not about feeling defeated. It's about changing how you operate. Stop reacting to news. Start reading on-chain data. Start following wallet movements. Start thinking like someone who has the information edge, because more of those tools are available publicly now than ever before. Point 4. How they manage position sizing like a science. Here's something nobody talks about in crypto education channels, and it might actually be the single most valuable thing I share today. It's not the strategy you use, it's how much of your capital you deploy in any given strategy. Position sizing. Hedge funds treat position sizing like a science. Retail traders treat it like a feeling. Oh, I really believe in this project, so they put 50% of their portfolio in it. Oh, I think Bitcoin is about to pump, so they go all in on leverage. That emotional, gut feel approach to sizing is one of the primary reasons retail traders lose money over time, even when their directional calls are correct. Hedge funds use mathematical frameworks to determine exactly how much of their capital to allocate to each position, based on the risk-reward ratio, the correlation to other holdings, and the expected volatility of the asset. One of the most well-known frameworks is the Kelly Criterion, a formula originally developed for gambling that has been adapted by institutional investors to calculate optimal bet sizing. The core idea is elegant and simple. You should bet more when your edge is large and the probability of winning is high. You should bet less when your edge is small or uncertain. And you should never bet so much that a single loss destroys your ability to continue playing.
In crypto terms, this means that even if a hedge fund is extremely bullish on an altcoin, they might only allocate 1 to 3% of their total portfolio to it, because they understand that even a high conviction trade can go wrong, and protecting the portfolio's survival is always the priority. This framework also determines when they scale in and out of positions. They rarely go all in at once. They build positions in tranches, buying incrementally as the thesis confirms itself, and trimming incrementally as targets are hit. This removes the psychological burden of trying to time the perfect entry and exit. It's mechanical, disciplined, and deeply unsexy, and it works. The retail investor looking to apply this today should ask one question before every trade. If this position goes to zero tomorrow, how does it affect my overall portfolio? If the answer is devastating, you're sizing too large.
Point 5. The long game. Portfolio construction across crypto cycles. The final piece of the puzzle is the one that connects everything together, and it's about time horizon and portfolio construction at the macro level. Hedge funds think in cycles, not in days, not in weeks, in full market cycles that span multiple years. They understand that Bitcoin operates on a roughly 4-year halving cycle. They understand that altcoins follow Bitcoin with amplified volatility. They understand that DeFi, NFTs, Layer 2s, and emerging narratives each have their own adoption curves within those macro cycles. And they build portfolios designed to capture multiple waves of appreciation across those time horizons. Here's what that actually looks like in practice. A well-structured crypto fund might hold 60% of its portfolio in what they call Tier 1 assets, Bitcoin and Ethereum. These are the foundational stores of value and the infrastructure plays. They go up in bull markets, they hold value better than anything else in bear markets, and they provide the stable core around which more speculative bets can be made. 20% might go into Tier 2 assets, established Layer 1 blockchains, large DeFi protocols, or infrastructure plays with significant network effects and real usage. Things like Solana, Avalanche, Chainlink. Assets that have survived at least one full crypto winter and demonstrated staying power. The remaining 20%, the high-risk, high-reward allocation, goes into early-stage opportunities. New protocols, tokens that haven't listed on major exchanges yet, ecosystem bets on emerging narratives like zero-knowledge proofs, decentralized physical infrastructure, or real-world asset tokenization on-chain. But here's the key insight most retail investors miss. That high-risk 20% isn't just randomly speculated on, it's thesis-driven. The fund has a specific narrative thesis. ZK rollups will capture 30% of Ethereum transaction volume within 18 months, and they build a basket of positions around that thesis, knowing that if the thesis is right, multiple positions in that basket will appreciate, and if any single one fails, the basket construction protects the downside. This is professional portfolio construction, not gambling, not vibes. A systematic, thesis-driven framework that captures asymmetric upside while managing downside through diversification and position sizing. Bringing it all together, let me summarize what we covered today, because I want this to land clearly. Hedge funds don't beat retail investors by being smarter. They beat retail investors by being more systematic, more disciplined, and more structurally prepared. They trade asymmetry, structuring positions so their downside is capped and their upside is open. They run delta-neutral strategies that make money in any market condition, not just bull runs. They leverage information edges through on-chain analytics, order flow analysis, and early access to deals that retail simply doesn't have. They apply scientific position sizing frameworks that ensure no single loss ever threatens the survival of their portfolio. And they construct portfolios around multi-year cycle thesis that allows them to ride multiple waves of value creation across the entire blockchain ecosystem. None of this is magic. None of this requires billions of dollars in AUM. Every single one of these principles can be adapted and applied by an individual investor with discipline and education. The crypto market is still the most democratized financial market that has ever existed. You can trade the same assets as a billion-dollar hedge fund. You have access to the same on-chain data they use. You have access to options and futures markets that let you build hedged positions. You have access to DeFi protocols that generate yield in any market condition.
The only thing standing between you and a more sophisticated approach to this market is knowledge and discipline. And now you have more of the former. Here's my challenge to you. Take just one concept from this video, just one, and actually apply it to how you think about your portfolio this week. Maybe that means setting a rule that no single position will ever exceed 5% of your total crypto holdings. Maybe that means spending 30 minutes exploring a free on-chain analytics tool like Glassnode or Nansen's free tier. Maybe it just means writing down what your actual thesis is for each coin you currently hold and asking whether that thesis is still intact. Small shifts in thinking create massive shifts in outcomes over time. That's true in crypto. That's true in every area of life. If this video gave you a new lens, a new way of thinking about how this market actually works, then share it with someone who's been investing on emotion and instinct alone. Because understanding this stuff isn't just about making more money, it's about protecting what you've already built. Subscribe if you want more content that goes beyond the surface level. Videos that treat you like a sophisticated investor, not just someone looking for the next moonshot call. The hedge funds hoped you'd never find this strategy. You just did. See you in the next one.